And welcome back, ladies and gentlemen. Good stuff to share with you today. Another good story. You like my stories, right? I hope you do, because I try to bring you real world stuff, things that really happen, and then use that to hopefully hit a point that will be helpful to you. So my story for this episode is to talk about Luke. Now, Luke is a fictitious name. I'm not talking about the guy in the Bible or anything else. So Luke came to me, was referred by one of my existing clients, and he had questions about his 401k account at work. And he also had questions about an insurance policy that he had been recommended by a local insurance agent. So I'm going to cover this over the course of a couple of segments. So first, let me talk about the big question that Luke had. Luke is putting money into his 401k account at work, and his question to me was, how much should I put into my 401k account? And should I diversify into other things? In other words, if I have money, I have cash, I've got money left at the end of the month, should I increase my 401k contribution so that I don't have money left over? So that that money will work for my retirement in the 401k account? Or should I diversify, because we hear all about the advantages of diversification? Should I also diversify into different types of investment accounts besides a 401k, like an after-tax account or a Roth account or a life insurance policy? So these were Luke's questions when he came to see me. So we talked through his situation first and foremost. We didn't start with the conclusion and work backwards. We first walked through, what are you trying to accomplish? How much are you putting into your 401k now? How old are you? What is your risk tolerance? What are your obligations? Do you have any debt? Do you have cash emergency fund built up? Do you have health insurance? If you're over 50, do you have a long-term care policy? All of those questions are part of the evaluation of whether or not Luke, or anyone for that matter, should increase what they put into their 401k. So in Luke's situation, and I've got some numbers for you, in Luke's situation, Luke is putting away $30 per paycheck, and he's paid twice a month. So basically $60 a month he's putting into his 401k. Now, we can stop right there. Luke is not putting anywhere near what he could into his 401k. And so for him to think about or evaluate other investment choices, I think, is premature. He also doesn't have a lot of cash on hand, so I'd like to see him build up some cash money for emergencies. He's also thinking about buying a home. Well, you're going to need cash for that too, Luke, so he needs to save money for that as well. So there are several things that Luke needs to do before considering some of these alternative investments. So first, if you have access to a 401k at work, and if the company is giving you a match on money you put in, if you're not putting in at least enough to capture that match, you are leaving some really wonderful dollars on the table. And so at the minimum, put in what you can to get all of the match. But in 2015, you can put as much as $18,000 into your 401k. And if you are 50 or older, you could put another $6,000 for a total of $24,000 a year, plus whatever the employer puts in. So there is significant room for Luke to put more money into his 401k. Now, so when I talked to him, I said, well, let's do this. First, I need you to build up your cash. So we agreed on an amount that would make sense for him to put away. I also want you to set aside a separate savings account for a future purchase of a home. And so we identified those things, and then we figured out how much money was left over, and he's going to increase his 401k contribution so that he can have more money going in for his retirement. And I gave him some numbers to think about that I'll share with you as well. I said, let's say that you increase that amount from $30 every paycheck or $60 a month up to $150. So when we did the math, $150 a month for 10 years, and if we assume an average 7% rate of growth on that money per year, net of expenses and fees, and it's an average 7, I didn't say every year, that may include some negatives as well as some positive returns. But if Luke or anyone else were to put in $150 a month for 10 years at 7% net, didn't touch it, kept putting it in there, then after a 10-year period, there would be $26,000. Now, if we look at another 10 years, so we talk about a total of 20 years, that $150 a month is now $78,000. And if we were to jack up our contribution to that $18,000 a year, 10 years would be $260,000, and 20 years would be $780,000. So I said, Luke, look, okay, put as much as you can in, and if you can get to that $18,000 a year and can do that for 20 years, and Luke is very much on the front end of his retirement planning. He has still got a lot of work years ahead of him. So for him, 20 years is part of his plan. If he puts that away, instead of having to go and look for other alternative investments, which I'm not saying he shouldn't consider at some point, but until you max out that 401k, really these other opportunities that are out there really are nothing more than a distraction in my book. Now, there are some financial people that might argue that you should be diversified, and I don't disagree with that at all. But that's really when you've got that 401k maxed out. Well, the devil's advocate position, that counter argument might be, well, yes, David, but you really need to have money in different places to diversify your tax situation. You need to have some of your money working in a way so that if taxes go up, you can pull from different accounts. And I don't disagree with that, but that's really a consideration after you've crammed as much as you can into your 401k, because it's difficult to beat tax-deferred growth when the dollars going in are not subject to income tax. And 401ks, 403bs, tax-sheltered annuities, 457, all these types of plans that are through an employer, that's the number one way to get pre-tax contribution and working of your dollars. Now, that doesn't guarantee you any type of return. It creates the opportunity for that tax-deferred growth. Now, once you have fully taken advantage of that, or at least to a large degree, then you can look at other options. Now, along the way, we can't ignore the need for cash. And I've had people come to me that I've done retirement planning for, and they are a year or two away from retirement, and they are doing a good job of putting money away into their 401k. And we start looking at planning their transition into their working years, into their retirement years. And this may surprise you, I've actually told people, ease up on your 401k contributions. They say, what are you talking about? That doesn't make sense. Don't you want me to max out my 401k while I have an opportunity? It's a little counterintuitive, but hear me out. I say, yes, that's all well and good, and I want you to have as much as you can in your 401k, but guess what? I don't see a lot of after-tax money in your financial circumstances. So we need to let some of your payroll, some of your income, go ahead and let it come out to you and pay tax on it. We need to build up some cash to make this transition. So putting money into 401k, great. Putting as much as you can, excellent. But it's not an isolated decision, and nor is the decision to do other types of investing outside of your 401k. You want to look at your total picture before you make a decision about an alternative. And we'll talk more about that on another segment. But just understand that when you factor all these things into your equation, you can plan much, much stronger.